The console of the future gets the currency of the future, Liberty Reserve gets coal for Christmas, and it's Bitcoin time for Time Incorporated. This is the week of December 18th, 2014. I'm Stephen Chun, and you're watching Money and Tech. Computer and digital currency enthusiasts alike are swooning over the recent announcement that Microsoft will begin accepting Bitcoin as a method of payment. The multinational tech giant and second largest company in the world stated in the blog post on December 11th that it has partnered with Bitcoin conglomerate BitPay to allow customers the option of funding their Microsoft accounts with Bitcoin to pay for items such as games and apps through the online Windows and Xbox stores. While the Bitcoin option is still somewhat limited to certain content, Microsoft is looking at the move as a test period to see if their integration of Bitcoin has greater potential. As Corporate Vice President Eric Lockhart states, the use of digital currencies such as Bitcoin, while not yet mainstream, is growing beyond the early enthusiasts. We expect this growth to continue, and allowing people to use Bitcoin to purchase our products and services now allow us to be at the front edge of that trend. For us, this is about giving people options and helping them do more on their devices and in the cloud. BitPay CEO Tony Gallippi welcomed Microsoft with open arms, calling the move the best endorsement for Bitcoin to date. And as BitPay Chief Commercial Officer Sunny Singh told Bloomberg on Tuesday,
"You know, in America, credit cards are very ubiquitous, and a lot of people use credit cards, and I like my United Miles with my credit cards. But internationally, a lot of people don't have credit cards. So there, Bitcoin has a very strong, valid use case, and now they'll be able to shop at Microsoft and purchase things that they normally weren't allowed to because they didn't have a credit card."
Google may have to pay up in light of the UK's recent announcement that it will be cracking down on firms that avoid taxes by shifting their profits into tax havens. The UK's new legislation, appropriately entitled the Google tax, will charge these multinational corporations a 25% tax on British profits, a significant increase from the 20% rate that most UK businesses usually pay. Set for integration in April 2015, the tax is slated to bring in almost $2 billion in government revenue over the next 5 years. However, the UK is not the only country taking a stab at Google. Spain will introduce a new intellectual property law, also playfully called the Google tax, in January 2015, which will require Google to pay local publishers should they use even a small portion of their content. Rather than ante up, Google News in Spain has shut down effective December 16th. Head of Google News Richard Gingras explained the decision in a blog post, saying this new legislation requires every Spanish publication to charge services like Google News for showing even the smallest snippet from their publications, whether they want to or not. As Google News itself makes no money, we do not show any advertising on the site, this new approach is simply not sustainable. Germany also recently passed a similar law, which eventually forced publishers to reach an agreement with the tech giant following its local news shutdown and the resulting decrease in the publisher's website traffic. Perhaps a similar agreement will come to fruition in Spain. Mere hours following the shutdown's announcement, the Spanish Publishers Newspaper Association, the AEDE, began asking the government for help in getting Google to come back, saying that Google is simply too strong an entity and that their absence will undoubtedly have a negative impact on future businesses. Online peer-to-peer credit company Lending Club has made an impressive Wall Street debut with its IPO announcement. The online's startup overall valuation rose 56% and is now considered one of the most valuable financial institutions in the country. And the company says it's just getting started. Investors such as largest shareholder Norwest Venture Partners, which holds approximately 50.8 million shares and a 14% stake, are the true beneficiaries and are causing other tech giants to wake up and smell what's cooking in Lending Club's kitchen. Similar organizations such as the nonprofit Social Finance and online marketplace Funding Circle are now offering a wider range of services to their customers, such as pitching student lending services and small business loans. As Funding Circle co-founder Sam Hodges states, "We see the Lending Club IPO as a bellwether for a major structural shift in the way that consumers and small businesses get access to credit. It's one step in what will be a multiple-step shift in companies like ours coming to scale and changing the ways that parts of a market work." As it turns out, the newly public company has also managed to set the stage for alternative lender OnDeck Capital, which is now looking to sell approximately 10 million of its shares within the $16 to $18 range for a total value of around $170 million. The The companies differ in the sense that Lending Club provides an opportunity for outside investors to lend to individuals, whereas OnDeck lends money to small businesses from its own pool. But OnDeck says that Lending Club has provided the route for their own plausibly successful stock market debut, which is set to begin Wednesday on the New York Stock Exchange under the symbol ONDK. Meanwhile, Lending Club is planning to use the money raised in its IPO to acquire other financial tech startups and expand on an international basis. The price of Bitcoin is a strange beast. It's like the hunt for Red October. As more people look for it and its popularity grows, the deeper it seems to go. This week, major companies like Microsoft and Time began accepting Bitcoin, which is great as the price still went down. As Binary Financial Managing Partner Harry Ye explained in our recent Coin Congress interview with him, this actually makes sense and isn't necessarily a bad thing.
Right now, you're not going to see the price go up because people are adopting it on Dell.com or Expedia. Because what's going to happen is, BitPay or Coinbase or any other payment processor such as GoCoin, when they take Bitcoins, if somebody buys a plane ticket, that vendor, unless they specifically want to hold Bitcoin, they have to offload it to somewhere. So they'll either sell it to a fund like ours or they have to sell it on the open market. And that actually creates selling pressure.
Basically, just because more merchants are accepting Bitcoin doesn't mean they're keeping the Bitcoin. So although the price may decrease, the transaction volume continues to rise. Bitcoin isn't the ruble, and its price decrease isn't an indication of a lack of faith or weakening market. It's quite the opposite. This week, the price surfaced for a moment on Thursday, seeing its high of about $358. But the rest of the weekend was dive, dive, dive. And at press time, the price of Bitcoin is sitting at around $320. As an interesting aside, this is the second week in a row that the hashing difficulty has gone down. What does that mean? Well, more people are keeping their miners off as the price drops because it's not as likely to generate a return of their investment. Now it's time to take a look at the wild, wild west of Bitcoin and the continuing fallout from those who bit off a bit more than they could chew. This is Got Gots. Mark Marmolев, former CTO for defunct payment processors Liberty Reserve, was sentenced to 5 years in prison on Friday. Earlier this year, Marmolев pled guilty to charges of conspiring to operate a money-transmitting business that failed to comply with federal registration requirements. Marmolev's defense attempted to argue that any wrongdoings Liberty Reserve had committed were merely necessities, given the company's aspirations to compete in the payments industry with major companies like PayPal and establish a foothold in the early days of digital currency. U.S. District Judge Denise Colt, who handed out the sentence, rejected the defense outright. Liberty Reserve was seized back in 2013 after a several-year-long investigation into the payments processor. Authorities alleged that Liberty Reserve had laundered over $6 billion in criminal proceeds. U.S. District Attorney Preet Bharara stated that they sought to create a sort of a black market bank, primarily to facilitate criminal activity. One of Liberty Reserve's co-founders, Vladimir Katz, pled guilty to charges last month, while his fellow co-founder Arthur Budofsky opted to plead not guilty after renouncing his U.S. citizenship and acquiring Costa Rican citizenship in a bid to avoid prosecution. Both men face up to 30 years in prison. Though, as Marmolev's attorney Seth Ginsburg claims, Liberty Reserve was neither all good nor all bad. Liberty Reserve was not as black and white as the government would have you believe. Time Incorporated has announced a partnership with leading payments processor Coinbase to become the first major magazine publisher to accept payments in Bitcoin. Readers of Fortune, Health, Travel, and Leisure, and most excitingly, This Old House, can now pay for their subscriptions using Bitcoin. The notable exception to that list is Time magazine, the namesake publication of Time Incorporated. But Time's enthusiasm indicates that it's only a matter of time until Time makes time for Time to have Bitcoin time. As Executive VP of Consumer Marketing and Revenue Lynn Bigger says, we're always looking for ways to make it easier for consumers to engage with our brands, and this pilot program will give Bitcoin users a seamless and simple way to purchase subscriptions. We hope to expand our partnership with Coinbase in the coming months to create more opportunities to provide greater value to our customers. Find more information on this week's news stories at moneyandtech.com. I'm Stephen Chun, and thanks for watching Money and Tech's Weekly News Update.